You know what fascinates me about pensions? It's not just the numbers. It's not even the strategy. It's the fact that one of the most important financial assets you'll ever own doesn't feel like an asset at all until suddenly it is. You spent decades earning it, quietly, paycheck by paycheck, year by year. And now it's about to become the foundation of everything. If you're sitting somewhere in America right now, getting ready to retire with a pension, I want you to slow down for a minute, because what I'm about to share with you could change the way you see your entire retirement. Not in a scary way, in a clarifying way, the kind of clarity that lets you finally exhale. Pensions are rare now. You probably already know that. Most workers retiring today don't have one. They have a 401k, some savings, maybe an IRA, and a lot of hope. But you have something different. You have something that used to be normal and now feels almost extraordinary. And yet most people retiring with a pension don't actually understand what they're holding. They think of it as just a monthly check, a nice little bonus on top of Social Security, but that thinking is exactly what causes so many pension holders to make decisions they later regret. So today, we're going to fix that. We're going to talk about what your pension really means, how to think about it, how to time it, how to protect it, and how to combine it with everything else so you don't just retire, you retire with confidence, real confidence, the kind that comes from understanding, not guessing. Before we go any further, one quick thing, if you haven't subscribed yet, now is the perfect moment. You won't regret it. This channel exists to help people just like you make sense of retirement without the noise, without the scare tactics, and without the sales pitches. Let me tell you about two people I've come across. Their stories stuck with me, and I think they'll stick with you too. We'll call them Patricia and Ruth, both 65, both retiring this year. On paper, you might assume one is far ahead of the other, but you'd be wrong about which one. Patricia worked as a nurse for 34 years at a regional hospital. She lives in a paid-off house in a quiet neighborhood, drives a 2016 sedan, and has about $185,000 in her retirement savings. She has a pension that pays her $3,400 a month for life, with a small cost of living adjustment built in. She also gets about $2,100 from Social Security. Ruth, on the other hand, spent 30 years as a corporate manager. She lives in a nicer home with a mortgage still attached. She drives a leased SUV, has $720,000 in her 401k, and gets $2,400 from Social Security. No pension, just her savings and her benefit. On paper, Ruth looks like the winner. But here's what surprises people. Patricia sleeps better at night. Patricia doesn't watch the stock market. Patricia takes her grandkids out to lunch without flinching. Ruth, with nearly 4 times the savings, checks her account balance constantly. Ruth worries about market drops. Ruth feels behind even though the numbers say otherwise. Why? Because Patricia has something Ruth doesn't. Patricia has guaranteed monthly income that doesn't depend on the stock market, doesn't depend on her withdrawal rate, doesn't depend on luck. Patricia has a floor. Ruth has a pile. And those are two very different things. I want you to imagine your retirement in 2 parts, not one big number, 2 distinct piles. Pile 1 is income that shows up no matter what. Social Security, pension, maybe an annuity. This pile doesn't care what the market does. It doesn't care about headlines. It just shows up month after month like clockwork. Pile 2 is your savings, your 401k, your IRA, your brokerage account. This pile fluctuates. It grows in good years, shrinks in bad ones. It's useful, but it's not reliable in the same way. It's a resource, not a paycheck. And if pile 1 is big enough, pile 2 becomes something else entirely. It becomes freedom money. That's what a pension does for you. It doesn't just add to your income, it changes the nature of your retirement. It moves you from depending on a portfolio to having a paycheck. And the emotional difference between those two is enormous. One produces anxiety, the other produces peace. Now here's where the real question comes in. Most people approach their pension by asking, how much do I get each month? But that's the wrong question. The real question isn't how much your pension pays. The real question is how your pension fits into the rest of your financial life. Those are completely different conversations. Because the size of the monthly check is only part of the story. What matters is whether that check, combined with Social Security, covers your essential expenses. If it does, congratulations. You've already won the hardest battle in retirement. You've built a floor of guaranteed income that will outlast you. That's a position millions of Americans wish they had. And yet, so many pension holders don't see it that way. They focus on what they don't have. They look at people with bigger 401k balances and feel like they fell behind. But they didn't fall behind. They were just running a different race. And in many cases, they were running the smarter one. You may already have what people with millions are searching for. Think about that. People with seven-figure portfolios spend years trying to recreate exactly what your pension already gives you. They buy annuities, they build bond ladders, they obsess over withdrawal strategies, all to manufacture the certainty you were handed. Let me ask you something. Have you ever calculated what your pension is actually worth in real dollars? Most people never do. They see the monthly number and stop there. But the lifetime value of a pension can be staggering, and once you see it, you'll never look at your retirement the same way again. Here's a simple way to think about it. If your pension pays you $3,000 a month, that's $36,000 a year. Over 25 years of retirement, that's $900,000 in payments. To replicate that with savings alone, using a safe withdrawal rate, you'd need somewhere in the neighborhood of $900,000 to $1.2 million set aside, just for that income, just for that one piece. So when you hear that you need $1 million to retire, and you start to panic because your savings are nowhere near that, pause. Because if you have a pension, you've already been building that $1 million. You just built it differently. You built it in a form that pays out instead of one that sits in an account. Now let's talk about the decisions you'll actually face. Because retiring with a pension isn't automatic. There are choices in front of you, and some of them are permanent. The biggest one is how you take the payments. Most pensions offer multiple options, and most people pick the wrong one because they don't fully understand the trade-offs. The most common choice is between a single life annuity and a joint and survivor option. The single life version pays the highest monthly amount, but it stops the moment you pass away. The joint version pays a smaller amount each month, but it continues for your spouse after you're gone. That difference is everything. I've seen too many people pick the higher single life option without thinking it through. They focus on the bigger check now and forget about what happens later. And then a spouse is left with Social Security alone, suddenly facing the same expenses with far less income. That's a story I never want to be yours. Here's a question for the married folks. Have you and your spouse ever actually talked about what happens if one of you is gone? Not in a theoretical way, in a real, practical, sit-at-the-kitchen-table way. Because that conversation matters more than almost any other one you'll have about retirement. If your spouse depends on your pension to live, the joint and survivor option is almost always the right choice. Yes, the monthly amount is smaller, but the protection is bigger. And retirement isn't a race to get the biggest check. It's a marathon of staying secure no matter what life throws at you. Then there's the lump sum option. Some pensions let you take everything as a one-time payout instead of monthly payments. This sounds attractive, especially when the number is large. But before you sign that paperwork, you need to understand what you'd be giving up. You'd be trading certainty for control. The pension is doing something powerful for you. It's pooling longevity risk with thousands of other retirees. It's promising to pay you for life, no matter how long that life turns out to be. The moment you take a lump sum, that protection disappears. Now you're managing the money yourself, and you're betting that you can do it better than a professional fund. Some people can, most can't. Not because they're not smart, but because managing a lump sum for 30 years requires discipline, market timing, tax planning, and emotional steadiness through every recession. It's not impossible. It's just harder than it looks. And the consequences of getting it wrong are severe. There's also the inflation question, and this is where pensions get tricky. Some pensions have cost of living adjustments built in, which means your payments rise over time. Others are fixed forever. A pension that pays $3,000 today might still pay $3,000 30 years from now, even when bread costs 5 times more. Inflation is like an ice cube in the sun. It doesn't melt all at once. It creeps, it nudges, it slowly raises the cost of everything around you. Your groceries, your insurance, your healthcare, and if your pension doesn't adjust, that ice cube will keep melting year after year until what looked like a comfortable income feels surprisingly tight. This is why pension planning isn't really about today. It's about 30 years from today. The decisions you make now don't just affect this year. They affect every year you live, including the ones where you'll need that income the most. Slow down, run the numbers. Look at how your pension behaves in year 1 and year 20. Now let's bring Social Security into the picture, because a pension by itself is great, but a pension combined with Social Security, timed correctly, becomes something special. These two income streams working together can create a floor so strong that nothing the market does will shake you. Most people take Social Security too early. They claim at 62 because it's available, or because they're worried it won't be there later, or because they just want the money now, and that's their right. But early claiming permanently reduces your benefit by about 30% compared to waiting until full retirement age. If you wait until 70, you get an even bigger boost, about 76% more per month than if you claimed at 62. That's not pocket change. That's the difference between a comfortable retirement and a tight one. And for someone with a pension, this calculation matters even more. Here's why. If your pension already covers a big chunk of your essential expenses, you have flexibility that other people don't. You don't have to rush Social Security. You can let it grow. You can let it compound. You can turn it into a much bigger lifetime stream simply by being patient. Think of Social Security not as an endpoint, but as a safety net, one you paid into your whole life, one that's designed to catch you when you need it most. And the longer you wait to grab onto it, the higher and stronger that net becomes. That's not delayed gratification. That's strategic income building. A lot of pension holders ask me, should I work until 70 just to delay Social Security? Not necessarily. You can retire when you want. But if your pension and your savings can carry you until 70, the math often works out beautifully. You bridge those years with what you've already built, and then Social Security kicks in at its maximum. The real question isn't what age you should claim. The real question is what claiming age gives you the strongest income for life. And the answer depends on your pension, your savings, your health, your spouse, and your goals. There is no one-size-fits-all. There's only what's right for you. Let me give you another way to think about this. Think of your benefit like a faucet. Behind that faucet is a pipe, one you've been filling your entire working life. Every paycheck, every tax contribution, every year of service has built pressure in that pipe. The longer you let the pressure build before you turn the faucet on, the stronger the flow when it finally comes. And if you wait too long to turn it on, well, no. That part doesn't apply here. The pressure keeps building until 70, but it doesn't go past that. So your job is to find the moment when turning the faucet on produces the strongest sustainable flow for the rest of your life. For most people with pensions, that moment is later, not sooner. Now I want to talk about something that doesn't get enough attention, the emotional side of retiring with a pension. Because here's the truth. People who have pensions often feel guilty about their security. They feel like they got something other people didn't get. They feel uncomfortable when friends complain about not having enough. Don't carry that guilt. You earned this. You worked for an employer that offered a pension, often in exchange for lower wages or less flexibility along the way. You stayed. You built tenure. You sacrificed. The pension wasn't a gift. It was a delayed paycheck. And now it's finally arriving in the form you were promised. What I want you to do is shift your mindset from guilt to gratitude. Not because gratitude pays the bills, but because gratitude changes how you experience the money. People who feel grateful for their income enjoy retirement more. People who feel guilty about it shrink their lives unnecessarily. Don't shrink. Live. You don't need perfection to have a successful retirement. You need clarity. And clarity comes from understanding what you have, what it can do, and how it fits with everything else. A pension is one of the most powerful tools in a retiree's toolkit. Use it. Lean on it. Let it do the job it was designed to do. Now let's talk about expenses, because no retirement plan works in isolation. Your pension is one side of the equation. Your spending is the other. And most people, even people retiring with pensions, underestimate what they'll actually spend. Not by a little, by a lot. The classic mistake is thinking that expenses go down in retirement. Some do. You're not commuting. You're not buying work clothes. Maybe the mortgage is gone, but other expenses quietly rise. Healthcare, travel, hobbies, helping family, home repairs. They creep in over time, and they don't always announce themselves. Inflation makes it worse. Even modest inflation, around 3% a year, doubles your cost of living in about 24 years. So the lifestyle that costs $5,000 a month today will cost roughly $10,000 a month at the back end of a long retirement. If your pension is fixed, that's a real problem. If it adjusts, you're in much better shape. This is why I always tell people to build their plan around income that grows, not just income that exists. Social Security has cost of living adjustments. Some pensions do, some don't. Knowing exactly which type of pension you have isn't optional. It's the difference between a plan that works and a plan that quietly erodes. Let me ask you something. Do you know what your monthly income will actually look like in real terms 10 years into retirement? Be honest with yourself. Most people have a rough idea of year 1, but no idea what their plan looks like in year 15. That gap is where retirement plans quietly fall apart. Now here's something that surprises people. Having a pension doesn't mean you ignore your savings. It means you use your savings differently. When your essential expenses are covered by guaranteed income, your savings stop being survival money. They become opportunity money. They become flexibility. They become the fund that pays for memories. That's a completely different mindset. Most retirees withdraw from savings nervously, watching every market dip with their stomach in knots. But when your pension covers the basics, you can withdraw from savings strategically. You can take less in bad years. You can take more in good ones. You can let it grow when you don't need it. It's not about who has more saved, it's about who has more certainty. And certainty changes everything. It changes how you spend, it changes how you sleep, it changes how you make decisions, it changes the very texture of your daily life. The retiree with certainty isn't constantly recalculating, they're just living. Let me give you a few real strategies for making your pension work harder. First, get the official statement. Not the rough estimate, not the verbal explanation, the actual document that lists your payment options, your survivor benefits, your COLA terms, and any lump sum offers. Read it slowly, highlight what you don't understand. Second, model the scenarios. Sit down with a calculator or a spreadsheet and look at each payment option. What does the single life option produce over 30 years? What does the joint option produce? What happens to your spouse if you die at 75, at 85? Run the math, don't guess. Numbers don't lie, but assumptions do. Third, coordinate with Social Security. Don't make your pension decision in a vacuum. Look at how your pension and your Social Security stack together at age 62, 67, and 70. The combinations are different. The total lifetime income is different. The survivor protection is different. There's almost always one clearly better path. Fourth, plan for inflation. If your pension doesn't adjust, build a buffer. Save more aggressively in your last working years. Keep a portion of your investments in growth assets to combat erosion. Have a plan for what you'll do if your fixed pension starts feeling smaller in real terms 5 or 10 years in. Fifth, protect your spouse. I cannot say this enough. If you are married, your pension decision is not just about you. It's about the person you love. Choosing the higher single life payment because it looks better today can leave your spouse in a difficult position later. That's not strength, that's short-sightedness. Now, I want to address something specific to pension holders that nobody talks about: the risk of your former employer. Most public pensions are stable. Federal pensions, state pensions, military pensions, teacher pensions, these are generally well protected. But private pensions, especially from struggling industries, carry some risk. If your pension comes from a private company, find out if it's insured by the PBGC, the Pension Benefit Guaranty Corporation. Most are. That insurance protects a significant portion of your benefit if the plan ever fails. It's not unlimited, but it's substantial. Knowing this can give you real peace of mind. For public pensions, the risk is different. It's not bankruptcy. It's slow erosion through legislative changes or weak cost of living adjustments. Stay informed. Read your annual statements. Pay attention to news about your plan's funding status. You don't have to become an expert. You just have to stay aware. Here's a thought. If the system only gives you almost enough, you will spend your entire life chasing more. How does that make you feel? Most people with pensions are not in that situation, but they don't know it. They feel like they're missing something because the financial industry has trained them to focus on portfolio size. But your pension isn't a portfolio. It's something better. It's a promise backed by decades of contributions, regulations, and in most cases, federal protection. Once you see that promise for what it is, the constant chase ends. You stop measuring yourself by other people's account balances. You start measuring yourself by your own income reality. Let me give you a simple framework I want you to remember. 3 buckets. The first bucket is guaranteed income. Your pension, your Social Security, anything else that shows up monthly no matter what. This bucket should cover your essential expenses: housing, food, utilities, healthcare, basic transportation. The second bucket is your safety reserve, 6 months to 2 years of expenses in cash or near cash. This bucket is there for emergencies: a new roof, a medical surprise, a car that finally dies. When this bucket is full, you don't have to touch your investments at the worst possible time. The third bucket is your growth and flexibility money. This is what's left in your 401k, IRA, or brokerage account after the first 2 buckets are set. This money can stay invested. It can grow, it can fund travel, gifts, hobbies, and the life you want, not just the life you need. This is your freedom fund. When you have a pension, building these 3 buckets is much easier. The first bucket is already partly filled the moment you retire. That gives you more room to keep the third bucket invested longer. You're not forced to sell stocks in a downturn to pay your electric bill. You can wait. You can be patient. You can let recoveries happen. The goal isn't just to survive retirement. The goal is to enjoy it. And enjoyment requires room to breathe. A pension gives you that room. So does Social Security. So does a smart withdrawal strategy. None of these things alone are enough. But together, properly arranged, they create a retirement that feels solid instead of fragile. I want to gently challenge something the financial industry has been telling you for decades. They've been telling you that you need $1 million or $2 million or some other big number to retire well. And for people without pensions, that math might be roughly correct. But for you, the math is different. If your pension covers most of your essentials and Social Security covers the rest, you may not need $1 million at all. You may need a fraction of that as a supplement, as a cushion, as a fund for the things that make life sweet. That's a completely different starting point. And it's the truth most pension holders never hear. Here's another quiet truth. The retirees I see who feel the most secure are not the ones with the biggest portfolios. They're the ones with the most predictable income. Predictability is underrated. Predictability is what lets you plan a vacation a year out. Predictability is what lets you say yes to your grandkids without doing mental math. Predictability is peace. So if you're sitting there with a pension, please don't undervalue what you have. Don't look enviously at the person with the bigger 401k. They might be looking enviously at you. They might be wishing for exactly what you've already built. They might be losing sleep over the very thing you take for granted. Stop measuring yourself against everyone else. Start focusing on what truly gives you freedom. Your pension is freedom. Your Social Security is freedom. Your paid-off home, if you have one, is freedom. These aren't small things. These are the things that make retirement work. They are the things that make a life feel safe. There's one more thing I want you to think about before we wrap up. Taxes. Pensions are usually taxable as ordinary income, just like a paycheck. Social Security can be partially taxed depending on your total income. So your gross pension number isn't what hits your bank account. Your net is what matters. Sit down with a tax professional before you retire, or at least early in your first year of retirement. Understand your tax bracket. Understand how withdrawals from your traditional retirement accounts affect your Social Security taxation. Understand the difference between pre-tax and Roth money. Small adjustments here can save you thousands per year over a long retirement. And while you're at it, look at your state. Some states tax pensions heavily. Some don't tax them at all. Some give pension exclusions. If you're already considering a move, taxes can be one factor in that decision. Not the only one, but a real one. A few $1,000s a year, multiplied by 20 or 30 years, becomes serious money. I know we've covered a lot, so let me bring it all together with something simple. There are people with millions of dollars who don't feel secure. And there are people with modest savings and a steady pension who sleep soundly every night. The difference isn't the number. The difference is understanding. Understanding your income, understanding your expenses, understanding what actually matters. That's the difference between stress and peace. If you're retiring with a pension in the United States, you are standing on a foundation that most retirees today will never have. Take a moment to acknowledge that. Then take the time to understand it deeply. Run the numbers. Make the right elections. Protect your spouse. Plan for inflation. Coordinate with Social Security. Use your savings wisely. And then enjoy what you built. If this video helped you see your retirement in a new way, hit that subscribe button. I've got a lot more where this came from. I'll be making more videos on pension planning, Social Security timing, withdrawal strategies, and the real-world questions that matter most as you step into this next chapter. I'd love for you to be there for them. You've worked your whole life for this moment. Now's the time to step into it with eyes wide open, with clarity, with confidence, with the quiet certainty that comes from understanding what you have, not just hoping it will be enough. Because when you understand it, when you really understand it, you don't have to hope. You just know.